Morning, everyone. This is a quick seminar on the real estate passive income. And what really is passive income? Basically, the name speaks for itself. Passive income is where you're not involved in um, uh, day-to-day management or generating the income yourself. That would be active income. So passive income is, it could be even interest in your money from RSP or other investments where you're not involved in day-to-day management. That's really passive income, and we're going to talk today about passive income in real estate. There are different types of passive income from real estate. It could be residential properties, condominium rental market, and the pre-construction condo market. So passive income is generating income with very little involvement on you personally, and it can be like I said, various investments, online business. But you could, I guess, online business could be described as where you put stuff up for sale, and you wait for clients to come in and they pay through online, and then you ship the product. But I wouldn't call necessarily that as passive income. The whole purpose behind passive income is to um, provide you with additional income, additional spending income to top off whatever else you're doing. Plus, it gives you some sort of security in case your employment changes, or as for us, the real estate agents, we are really dependent on the market and its fluctuations. So it gives you the stability and also put aside money for retirement. So passive income is basically leveraging what you have, maybe a property that you own or savings, even RSPs and so on, and you can invest money into. There's different options: buying a property you can rent out, a multiplex unit, a condominium, or a pre-construction. Now, the key here is calculating what it is. What Firstly, you need to determine what your expectations are, what the purpose of this investment is, and what the costs associated with the investment are. If you're buying investment property, you have rental income potentially, and then but you do have property tax you have to consider. You have maintenance fees in case of condos, or even any property you have to maintain it. You have repairs, you have cleaning, you have damage from tenants, um, legal expenses, insurance. You have to consider all these little things, and you have to make sure that you're always ahead of the game, or you're going to end up in the red very quickly. And when you're considering income, um, just make sure that you allow for vacancies and other unexpected expenditures. You have to treat it as a business. So, what are the options? Well, let's say you can buy a house, and you can, uh, if you're living in a house, you can rent out the basement. That's passive income. Or you can buy a whole house and chop it up into pieces and rent it out. Just make sure that it's legal. You have permits to do that, and and it's done properly. Because if God forbid there's a fire in the property and somebody dies, somebody is injured, it's on you. And if the house is not um, is not legal boarding house or whatever it may be, an apartment, you may be liable and may go to jail. So just keep all these things in mind. This is why we have legal basements and non-conforming basements, and this is why we, as a brokerage, don't deal with non-conforming basements. It's there to protect you as agents. And but if you're doing it yourself, just keep that in mind. That you wanna protect yourself and your investment. Um, the other there is pre-construction condominium investments, and you can buy an existing condominium or you can buy a pre-construction condo. The benefit here is you have the ability to rent out a property. If it's pre-construction, you may be able to assign one, which is tough, but there's that. There's appreciation over a period of time that you enjoy. So besides the rental income, there is appreciation in the value of a property, and somebody else, the tenant, is paying down your mortgage. So this is how you're building equity without taking money out of your own pocket. And you have to be, again, very careful in keeping in mind what kind of rent you're going to collect and what kind of expenses you're going to incur. And some people are quite happy with breaking even on the rent because they know that over a period of time, the benefit will be from the appreciation, and the appreciation could potentially be quite substantial. The other investment option is a multiplex, and multiplex, could be anywhere from 3 to 6 units, 10 units, all depends on your budget. But again, it requires potentially, if it's in GTA especially, a higher investment. But also keep in mind that as you're carrying it, you have a larger mortgage. I actually know somebody who had a triplex, and one of the tenants moved out. This is a few years back. Couldn't find another tenant for a while. Almost lost the whole property just because they didn't have the money to carry it for an extended period of time. So you always have to take these into consideration. So in case of pre-construction condo, it's sort of the easiest, probably less expensive investment. Before I get into pre-construction condo, I'd like to speak just about resale. The difference between resale and pre-construction is that resale potentially is less expensive than pre-construction. Will it require lesser deposit? And to start off with, you could, you buy with 10% down versus 20 or 25. And then you can rent it out, but it may be older, so it'll have higher maintenance fees. It may need renovations and require that investment. So there is a give and take. It depends what you want to invest in, what you want to deal with. Okay, and the thing is, with an existing resale condo, you're gonna have when you do decide to sell, you're selling it. When you bought it, you own it. It's not like you have to wait 5 years for it to be built. So there's a time consideration as well. So the benefit of pre-construction, you have a deposit that's spread out over a period of time, and you are putting in 20%. So you're not going to have to deal with CMHC when it does come time for insurance. I mean, getting a mortgage. And even though it says, very often the deposits are spread out over 2 to 3 years. Closing might now be for 5, 6 years. I've sold pre-construction projects where they took 10 years to close. So it's not uncommon. We have right now one Forma that's coming up, about to be launched. They're actually saying, I believe the completion is 2028. So it's quite a ways out. So don't expect to be finished when they say they will. It's going to be probably another couple of years. You're able, with pre-construction, you're able to choose the floor plan. You're able to choose the layout, the direction the unit is facing, the floor level. So there's a little bit more choice than pre-construction. Okay. And then you have, of course, warranties as far as for the appliances and finishes and so on. And you get that. And as a client, if you're selling to a client, you're going to get 4% commission. That's typical. Not on low rise, but definitely on high rise. This is the pretty standard commission rate. You may be able to assign a property, but I believe we just got introduced HST. So how much of a benefit to assignment there is still questionable. You have to do the math on that. And of course, once it's built, you can rent it out, and you can probably get higher rent in the new building than you can on the resale. So like I said, there's give and take between resale and pre-construction. Um, um, some things you have to be aware of in pre-construction when you do uh, once the building is under construction and it's coming close to completion, you're going to have interim occupancy. So you're actually paying rent to the builder during that period of time. You're giving keys, but you still don't own it. And some builders will not allow you to rent it out unless it's done through them. So they control the whole process. To be very aware of various rules that play out when it comes time to take possession. So, here's an example how you could be making money from a pre-construction condo. Example, you purchase a condo for $800,000, typical one bedroom these days. Deposit over a period of time is $160,000, which is, could be 30 days, 90 days, 120, the 270, and then 5% closing. So the balance due on closing is $640,000. For the sake of calculations, I'm not going to be including, a closing cost, a land transfer taxes, and so on, because that is really in addition to and can be then used when you have to sell and it's capital gains. Now, to really justify the carrying costs, and so that you're not really subsidizing the property at huge rates with current prices versus rents, you'd have to put down additional money in closing. And I'm talking about probably around $200,000 just to justify it. So you have a mortgage of $440,000, and then you have rent $2,500, which will actually cover your all your costs of carrying it, pretty much at least the mortgage, anyways. Then you have the return on investment, which is $30,000, but into your investment of $360,000 works out to 8.3%. So that's the positive cash flow from rental income alone. So you have that. Then I always tell my clients, you got to keep the condo for about 4 to 5 years after closing. That's when you maximize the appreciation of the property. Condos seem to slow down after that because they become older and they become less desirable, and not as much as in demand. So after 5 years, you might want to be selling it. And so if you figure out the appreciation over 5 years, and you so you have $200,000 from appreciation on the value or the total amount, and $149,000 that you earned from over 5 years from the rent. You do the math. You're looking at about almost 100% return over 5 years, which works out to about 20% per year, which is a pretty good return on your investment, if you ask me. I don't think you can get that from a bank. The other option is multi-residential units, and this is or commercial units. It doesn't matter. The calculation is basically the same. If and again, these are round numbers for ease of calculation. Purchase price is $2 million. A cap rate using 5%, which means it has an annual net income of $100,000. Which means if you bought a property for $2 million with a cap rate of 5, you're going to have an annual income of $100,000. Now, not everybody has $2 million in their back pocket, so you want to borrow money. And if you're looking at a mortgage interest rate of 4%, now when you're buying a multi-res unit, you can get financing for 80% of the value. So you would have to, in this case, I use $500,000 as a down payment. So if you calculate the income, you have 5% on $500,000, which is the net income. And then if you deduct the 1% that's left over, on the borrowed money, you have 1% and 1.5 million, which means 25,000 plus 15,000, you have $40,000 return on your investment of $500,000. So the effective rate of return is actually 8% per annum. Again, that's way better than dealing with a bank, investing in a bank, or other types of sources. You can also invest into second mortgages will give you 8 to 12% return. There's various options in as far as passive income is concerned, but this is just a couple of examples how you can have additional income from your investment. And this would, especially in commercial or multi-unit residential investment, this is where most people don't understand. They go, "Oh, why would you buy something with 5% cap or 6% cap? It's not really enough," and then borrow money at 4%. Like, you're not making money. But you have to calculate it properly, and you see that the actual effective rate of return is a lot higher on your actual investment, the actual money you invested, because you're not investing mortgage. Mortgage is not your money. So on your money, the return is quite decent. And again, depends what the spread is between the cap rate and mortgage rate. I've seen 15 to 20% return on the money. So be vigilant and do your math, and make sure you always check for determining the actual cap rate and whatever is being reported, that it's actually proper. And you need to have professionals look at the numbers, because a lot of people who sell commercial properties, first thing they do is they actually deduct. They take out personal management fees for themselves or for management of a property. What does that mean? That means they say they're working for free, but you need to consider that as a salary, their wages, whatever it may be. And if you put that back in, the cap rate all of a sudden doesn't look as appealing as it should.
Thank you so much for watching. If you like our video, please hit the like button, the subscribe, and even the little bell to get notifications, just so you can stay in touch and watch more of these great videos.